Every single day, I work with people who are nearing or are already in retirement, and they're asking a few primary questions. And one of them is when and how should I lower risk within my portfolio? I'm your host, Eli Freeman, a certified financial planner, and this is Data Brief, where we break down the data behind investing so you can make better decisions based on facts and not feelings. As always, let's look at the data. The answer centers around something that's called sequence of return risk, which I've spoken about on this channel. Sequence of return risk is the idea that the timing of investment returns matters when withdrawals are being taken from a portfolio. Before retirement, market declines are often less damaging because contributions may still be going into the account. But once withdrawals begin, poor returns early in retirement can create longer-term challenges, especially if those returns are paired with high inflation. At first glance, many people assume that the biggest risk is a bad year or maybe 2 years in the market that happens right after retirement. But according to the research that Kitces did, that is not typically the primary problem. Historically, short-term downturns, even severe bear markets lasting a year or two, have not been the most significant predictor of retirement failure. Instead, the greater risk tends to be sustained poor returns over roughly the first decade of your retirement, particularly when combined with high inflation. And that's an important distinction. A sharp market drop that recovers relatively quickly can often be manageable within long-term strategies. The challenge is that investors don't know in real time whether a downturn will be short-lived or persist for an extended period. If weak returns do persist, retirement savings can slowly be whittled down, and over time there may not be enough to recover in your portfolio. In Kitces' analysis, the first 10 years of retirement appear to be the most influential period for determining your long-term retirement outcomes based on his historical data. Because of that, he discussed how some investors may consider evaluating their portfolio risk roughly 10 years before retirement and throughout the first 10 years after retirement. One of the charts in his research looks at 1-year nominal returns and the corresponding safe withdrawal rates using historical market data. What you'll see on the chart is that it shows that single-year returns have no consistent pattern when it comes to retirement outcomes. Safe withdrawal rates vary widely, and even strong market years can be associated with relatively lower withdrawal assumptions. This highlights why single-year performance is not a reliable guide for long-term retirement planning. It also helps explain why relying solely on emotions, whether markets are performing well or poorly, can be problematic, and why many planning approaches emphasize having a structured framework for distributions, not based on your feelings. Another chart in the research examines a hypothetical retiree who's invested in a 60-40 portfolio, 60% stocks, 40% bonds, during the first 10 years of their retirement. In this specific historical analysis, he observed safe withdrawal rates do not fall below 4%. One takeaway from this data set is that it aligns with research often cited in discussions of the traditional 4% rule, though outcomes can vary significantly depending on market conditions and assumptions. Another interpretation is that some investors may begin to think about adjusting portfolio risk as they move closer to retirement. In this example, the portfolio that was examined was 60% stocks and 40% bonds. By contrast, portfolios invested entirely in stocks have historically experienced greater volatility. Research, including the work that was done by the creator of the 4% rule, has shown that in certain market environments, higher volatility has challenged the traditional withdrawal assumption. To move toward a more balanced allocation, like a 60-40, Kitces discussed several options and different approaches. Over a long time horizon, future contributions might be directed toward fixed income to gradually shift the overall mix. In other cases, periodically rebalancing over time, gradually reducing your stocks and increasing bonds, has been discussed as another approach. These are examples drawn from a financial planner who's taken historical data and worked it forward. The appropriateness of any strategy depends on your individual circumstances, market conditions, and risk tolerance. What this does not suggest is that stocks should be abandoned entirely, because retirement can still last for 25 to 35 years or longer, so growth remains an important consideration. However, portfolios may become more balanced during what Kitces calls the danger zone surrounding retirement. Inflation plays a key role here because retirement spending often rises over time. If inflation is elevated early in retirement, withdrawals can quickly increase and place additional strain on a portfolio. Historically, the combination of sustained poor market returns paired with high inflation early in retirement has been the most challenging. So, in summary, The goal is not to eliminate risk entirely. The goal is to understand when risk may matter most for your financial plan. For many investors, that may involve gradually adjusting portfolio risk as retirement approaches, maintaining flexibility in spending, or considering different planning frameworks during difficult market environments. Because retirement planning isn't just about average returns. It's about navigating periods when markets and inflation work against portfolios at the same time. According to the historical data discussed in the article, those risks appear to be most significant in the 10 years before and the first 10 years of retirement. I hope you enjoyed this video. If you're interested in exploring alternative approaches or different approaches to retirement withdrawals, such as dynamic spending frameworks or the 4% withdrawal rule, I've linked another video here.